Hello, in this lecture we're going to talk about the comparison of two long-term projects, 5 years and 4 years. It's kind of a typical type of problem that would come up in a managerial accounting situation, in that if we have two types of investments, which one should we invest in? And there's different types of measurements we can do, some faster, some not as fast, and some that would be more accurate in order to get to a decision on these types of things. So we're going to go through a few of these. One's going to be the expected net cash flows, what we're going to calculate first. Then we'll calculate the payback period, we'll calculate the accounting rate of return, and the net present value at a 7% rate of discount. So the data's on the left-hand side here. We got the initial investment. Basically, we are thinking about investing in machinery. The cost is the same in this case of the 340 versus the 340, project A, project B. The machine is going to have a 5-year life in project A, a 4-year life in project B, and then we have the production annual results. So we're going to have sales here, and then we're going to have the related expenses under project A and project B, and try to do a comparison based on this. So first, let's calculate the expected net cash flows per year. We will start off with the net income in the two projects. I'm going to have two columns under each project. I'm going to put the net income in the outer column. We're not talking about debits and credits here. It's just going to be a format to set up the worksheet. So we got the net income of 53,440 and tab 34752. I'm just picking those up from this line item down here in the given data. And then we're going to subtract from that non-cash depreciation. So we're trying to get the cash flows, and there's going to be, of course, if we look at this set of data, we've got the direct materials, that's cash probably. We've got direct labor, we're going to say cash. The depreciation, that's a non-cash item. That's something we need to pull out. So in order to do that, we're going to have a quick calculation. So I'm going to say less the non-cash depreciation, I'm going to put a colon, and we're going to calculate what that is. So I'm going to say equipment cost, and we're going to say the cost is 340,000. We're going to say the useful life, I'll just put the life here, is going to be, in this case, 5. And let's put the data on this side too. It's going to have versus the 340,000 and life of 4. And then if we then look at what the annual depreciation would then be, going to be over here in the outer column. I'm going to pull this back out to the outer column. I'm going to say equals, it's going to be the 340,000. We're going to say divided by the 5-year life in this case. Therefore, we'd have depreciation of the 68,000. And that, of course, is the amount that is included in this number here that is not cash related, that we're going to pull out so that we can see the cash flow. And so we'll do the same thing over here. We're going to say this equals the 340,000 divided by the 4 years, and we get the 85,000. So then we're going to have the expected net cash flows per year here. So we're going to go back into the outer column. I'm going to say this is what the net income was, including the net income that was non-cash related, and we're going to add that back in, kind of like we would on a cash flow statement. So we add the 68, and there we have it. So we're going to do the same thing over here. I'm going to say this equals the 34,752 plus the 85,000, and there we have that. Now, if we wanted to clean this worksheet up a little bit, just to put some formatting into it, we could then maybe put an underline over here. I'm going to go to font group and underline here. And we have the decimal. We might want to indent these here. So I could go home and we could indent this and then maybe indent this again, like so. So a couple things, and we could put an underline here and an underline here, and maybe a double underline. I'm going to hold down Control on these two, and that might be a nice way to, clean it up a bit. Alright, so now we're going to calculate the payback period. So the payback period is going to be another kind of a quick calculation. It's not the best calculation, it's not the most accurate calculation, but this is kind of what you would think about of like a back of the envelope kind of calculation to try to figure out if it's worth doing. One of these projects are worth doing, and then you may want to drill down more and do more comprehensive. Why is it not as comprehensive? Because it doesn't take into account time value of money. It's going to be a very quick type of calculation. So we're going to say payback period, cost of investment, and the cost is going to be for both projects 340,000, and then we're going to divide by the annual net cash flow. And that, of course, is what we have calculated up here. So I'm just going to say this equals this number here, 121,440 tab. And for project B, this equals what we just calculated up here, the 119,752, and enter. and that's going to give us the payback period. All right, and then so we're going to take this equals the 340,000 divided by the 121,440, and I'm going to add some decimals here. So I'm going to go up to the home tab. We're going to go to the alignment. I'm sorry, we're going to go to the number group, add a few decimals. So we've got 2.8 years. 2.8 years. We should cover the costs. So we're going to do the same thing over here. We're going to say, okay, this equals the 340 divided by the 119,252. I'm going to go back up to the home tab, numbers, add some decimals. So the comparison here, there's going to be a nice comparison, just basically to say, okay, if we put the 340,000 in there, then when will we get that money back? You know, basically, how long will it take? Notice it's not the same as the life of the project. We're going to cover the costs of the project in 2.8 years and 2.84 years here. So that's when we'll cover the cost. Anything after that is basically over in terms of cash flow. Now, again, this isn't completely accurate because, one, it doesn't tell us what the overall profit is. It just tells us when we're going to get our initial investment back. And two, it doesn't tell us that what the time value of money. It doesn't take into consideration the time value of money, and those are the drawbacks of it. So it's a kind of a quick calculation. We're going to go here and underline it. I'm going to go to the home tab. I'm going to go font. I'm going to go and underline that. And we can also go to the second one and maybe double underline that. We'll go home tab. We'll go underline double. All right. Next calculation we'll try to see if to analyze these two projects will be the accounting rate of return. So accounting rate of return, we're going to start off with net income again, net income. And I'm going to put this into the outer column. I'm going to say this is the 53,440 for project A, and it's the 34,752 for project B. That's just the data that we have over here, the net income. And then we're gonna divide that by the annual average investment. Now remember, the initial investment is the 340 for both projects. So we're going to take that initial investment of the 340 for both projects here, and we're basically just going to divide by 2 years. And this always kind of drives me crazy because you might be thinking that we would be dividing by the 5 years to kind of average out the investment. And this is similar to some of the turnover type of calculations we have. We're basically kind of saying, kind of taking this as a balance sheet amount term, you know, as if we were taking the average of the balance sheet when we do a calculation, such as, you know, at the beginning of the year it had a balance sheet account of this, at the end of the year it has the balance sheet account at this at the end of the year. Therefore, we're going to take it and divide it by 2 as being kind of the average of where it is at the end of the year. So that's how I basically think of this as well. So we're taking that 340,000, that's the initial investment. There's only one investment. It happened at the initial part of the year, the first investment in the year in this case. We're going to divide that by 2, kind of the average over that year, and I'm going to go ahead and underline that and underline this, and then we'll divide that out. So we're going to take the 340,000 divided by the 2 here, and we'll do the same thing over here. This should be 340,000 in project B divided by 2. I'm going to go back over here. I'm going to format paint that, take that underline and put it right there. And we're going to take this equals the 340,000 divided by 2. So that's going to be our average. So there we have that. I'm going to go ahead and highlight these. I'm going to go to the home tab. I'm going to indent that. I'm going to go to this one here. I'm going to go to the home tab. We're going to indent that again. And there we have that. Then we can go, I'm going to put my cursor here and I'm going to hold down Control and highlight those 2 cells at the same time. Home tab. We're going to go to the font and underline those. And now we're going to calculate the accounting rate of return. So the accounting rate of return is going to be the 53,440 divided by the 170,000. I'm going to hit enter. We're going to go back here. Why is it 0? Because we need decimals or to make it a percentage. So I'm going to go back up to the home tab. I'm going to go to the numbers. I'm going to make it a percent and maybe add a decimal. And then we'll do the same thing over here. I'm going to do the same thing. I'm going to say this equals the 34,753 divided by the 170,000. Back on it. I'm going to go to the home tab. We're going to go to the numbers. We're going to make it a percent and maybe add a decimal there. Now this gives us a quick percentage that we can make a comparison of here based on the average, based on an estimate. Note that the drawback, of course, is it's a quick calculation. That's the plus of it. The drawback doesn't take into account the time value of money. So, and that's what we'll take a look at this time. It's going to be the net present value at 7% discount rate. Now we're going to try to put in that present value of money using a discount rate, and this would be more kind of a sophisticated type of analysis, one that we might want to do then later after we've done the kind of back of the envelope calculations and said, okay, we need to drill down on this a bit more. So we'll start off with the expected cash flows per year, and I'm just going to say this equals, and we calculated that up here, the expected net cash flows per year there, and then we're going to go over here and we're going to pull those same numbers down. So I'm just going to pull these numbers down from that calculation. So this equals the 121,440 tab, and this equals for project B the 119,752 and enter. So we're pulling those numbers down. Those are the cash flows, not necessarily the net income. Remember, we had to adjust for the the expenses that were not cash related. And then we're going to use the present value factor. Now, we could use a formula to do this. We could use tables to do this. Now, many books will use tables. Tables will be a quick way to do this. The tables will be standardized. They're based on a formula. When I used to look up the tables, they were kind of intimidated. I'd be confused on which table to look at. So notice when you start looking at these tables, you'll probably see 4 types of tables where one's going to be a present value of 1. And that's going to be if we need a present value at one particular thing, not a stream, not like an annuity. We basically are saying we have an annuity payment here. We're taking the payments over a 4 or 5 year time period, and they're all the same. So we don't have to do it like 1 year at a time. We could use this table and say, okay, what would it be for the year 2, year 3, year 4, and do basically 4 calculations on it. But we can use the annuity table. Now the future value of 1 means that we're taking the future value, not the present value. So we would be pulling our number as if it was a future value in that case. And what we want to do in this case is pull all current numbers back to what the present value is at this point in time. So we're not going to use the future value, and then we have the present value of an annuity at 1. And this is where we're going to look at this time. That's what we have here. We basically have an annuity. Why is it an annuity? Because the payments are the same. They're all the same going forward. Therefore, we don't have to take each year and look at it. If they were different payments, which we'll look at later, then we will have to do that. We'll have to say, okay, the payments in this year are different than the payments in the next year, and we'll have to figure out each year what the present value is. But since they're all the same this time, we can take the present value of an annuity. So just if we went back over here and we took a look at our table, you would think that if we took this number and that was the cash flow, that we can just multiply that times the number of years. If that's going to be the net cash flow, we'll just multiply that by 5 years for project A and 4 years for project B. But the problem is that we could put that money somewhere else, and there's going to be basically inflation, meaning the value of money is going to deteriorate over time. Therefore, we're going to look at it as at a discount rate of 7%. Where do we get 7%? Well, interest is probably between 1 and 3%. And then we're going to have to figure out kind of what could we do with our money outside of this. If we put it somewhere else, could we get a discount rate of, plus or minus that 7%? And that's kind of how we'd have to figure out what that discount rate is. It's going to be, we have to account for inflation. We got to account for the fact that we could put our money somewhere else. That's what we're coming up with, that discount rate. So now we're gonna be over here in our present value of an annuity, and all we do once we get the right table is we go to the percent on over here, and then we get the number of years. So for example, if we're talking about project A, where we had the 5 years, it's going to be 7 and 5. So right there, it's going to be 4.1002. So we'll pull back over here, and I'm going to go, okay, so that's going to be the present value factor of 4.1002, and I kind of want to see the whole thing, so I'm going to go to the Home tab. I'm going to go here. I'm going to increase the decimals there all the way out, and we can go ahead and underline that as well. I'm going to underline it, and then if we multiply that out, we're going to say, okay, there's the 121,440 times the 4.1002. And notice it's a 5-year project, but we're not going to multiply it times 5 because it's going to be worth less in today's days. So it's going to be something less than the 5 years, and that's what's going to give us the 497,928. So we're taking into account the present value. If we do the same thing over here for the 4-year project, we're going to have a different annuity number. So we have the present value of an annuity. 7% still, but we're going down to 4 years, which is that 3.3872. So we're going to take that number. This is going to be 3.3872. Going to go back here. I'm going to put my cursor here. I'm going to format paint that. I have my format painter up there, but you can use this format painter here. And then multiply that out. That's going to be 119,752 times the 3.3872. Enter. So there we have the present value there. There again, notice it's less than 4. That's the point. And so that is going to be our present value cash inflows. Now I'm just going to clean this up a bit. I'm going to highlight these. Going to go back over here. We're going to indent. I'm going to go back to this one. I'm going to home tab, alignment, indent that one. Okay, so now we're going to compare that to the present value of cash outflows. And that, for this case, is a real easy calculation. It's 340,000 because that's what, an extra 0. That wouldn't be a good investment there. And that's because we of course put the cash in up front in this case if we're purchasing the machinery and that's the only investment we have. Again, if we have a more complex type of project where we're going to estimate the receipts are going to vary and the cash flows would vary, then we'd have to present value the cash flows. But because of course this cash flow happened at the day 1 of the project, it's already at present value. Therefore, that's going to be equal to the 497,928 inflow for project A minus the 340,000 project B, and we have the same thing over here, the 405,624 minus the 340,000, and then we can go ahead and underline this one, home tab, font underline, double underline this one, home tab, font double underline. Okay, so now we can see, taking into account the present value factors, that project A is looking better at the 7% discount rate there than the project B. This one being the most sophisticated calculation we've done so far on these two projects because it does take into account the present value factor.